So a mortgage isn't just a debt, it's actually a tool that you can use for stability, wealth, and overall legacy. And when you do it the right way, then you'll be able to turn your home into an appreciating asset. And also, homeownership builds generation wealth, and it will give you peace of mind. And if you're new to my channel, my name is Meredith. I'm a mortgage broker. I put educational videos out every single week, so make sure you hit that subscribe button or give me a like in order to help support. Now let's get into it. Now, your landlord can raise rent anytime, but your mortgage is locked in. So you no longer have to deal with rent hikes or moving from house to house. And I know when I was renting, that was really stressful for me. And also, you're able to customize or improve your own space without having to ask any permission. And you also are able to build roots, community, and it gives you more stability because you're not having to move from place to place. And the biggest wealth hack that no one really talks about is owning a home through a mortgage, because every payment that you make ends up growing your ownership stake, which is called equity. And also, real estate appreciates over time, so you have an appreciating asset. And also, when you go to file your taxes, you're able to deduct your mortgage interest that you've paid throughout the year, and also the amount of property taxes, which gives you more savings when it comes to paying your taxes. So your monthly mortgage payment, it's not just one payment itself. It's actually 4 little payments disguised into one. And here's how it's broken down. So it's broken down into paying principal, interest, your property taxes, and your insurance. And how it works is your taxes and your home insurance are escrowed. And what that just means is every month when you pay for it within your payment, the lender itself collects it, and then at the end of the year or whenever it's due, they pay the home insurance and the property taxes for you on your behalf. And as time passes, more of your payment goes towards the principal, which means that you'll be building equity. And this one decision can change your monthly payment for years to come, and it's deciding between a fixed rate or an adjustable rate mortgage, because fixed rate loans keep the same payment anywhere from 15 to 30 years, and it's more ideal for stability. Now, ARMs, which are adjustable rate mortgages, they normally start lower for the first 3 to 10 years, then from there adjust based on the market rates at that time. Now, ARMs save you more money up front, but can be more riskier in the long term because you don't know what those rates will adjust to at that time. So if you think you can't afford a home, there are several options out there available for you. So number one, you have an FHA loan, which is for low down payment options. 3.5% is the lowest down payment, and it also gives a lot more flexible credit guidelines. So minimum credit score is going to be 620. Now you can go lower, however, you're going to get killed on the rate and the fees, and you also have to bring a lot higher down payment. Then you have a VA loan, and these are for active service members or veterans, and there is no down payment that's required on this type of loan. Then you have a USDA loan. There's no down payment required, but these are designed for buying in either rural areas, and it's also you have to qualify based on specific income and area requirements as well. And the biggest surprise for home buyers is closing cost, which is separate from the down payment. And you can expect the closing costs to be anywhere from about 2 to 5% of the home price that you're buying. And what includes into all these closing costs are going to be title fees, lender fees, it's paying your home insurance all up front, and it's also paying a portion of your property taxes as well. Then what you can do is you can actually ask the seller to cover the closing cost on your behalf, so you're only having to worry about the down payment, which this strategy a lot of my clients are using right now, so they're only having to come up with the down payment. But again, this has to be negotiated up front, and it's on kind of case-by-case scenario. And if you want to pay off your loan a lot sooner, it's a lot easier than you'll think, because you can start making extra payments. That reduces the total interest, and it can shorten the loan term as well, as long as you apply it directly to the principal. And also, refinancing can lower your interest rate, or you can change it from a 30-year to a 15-year or a 30-year to a 20-year. And also, you could do a cash-out refinance, and that will allow you to access your equity, and you can use it to pay off debt or fund any renovation. And the biggest mistake that a lot of homebuyers make is going with the first offer their lender gives them, because every lender offers different rates and the fees, so you want to shop around. Or you can end up using a mortgage broker like myself that can access multiple banks and can do the shopping for you. Then you'll also want to get pre-approved before you start house hunting, because not only does that also strengthen your offer, but you need to make sure that you know exactly how much you can afford. And if you're planning to buy a house in 2025 or 2026 and you want to know exactly how much is your buying power, click on the link in the description for a free consultation, and I'll be in touch.